You know how it is. When the stock market is doing great, we're told that means the whole economy is booming. It's like the ultimate report card for how well the country's doing. But is that really the whole story? Let's dig in and see what those big, flashy numbers are actually telling us.
I mean, turn on the news, and it's a constant drumbeat of success, right? The market's up, we're hitting historic highs, and it sounds like everyone's getting rich.
You hear about new companies going public, investors are scrambling to get a piece of the action, and it just feels like this global party that's never going to stop.
And that's the story we're all sold. A rising stock market is like a rising tide that lifts all boats. Simple as that. But does it really?
Because when you take a step back and really look, a very different picture starts to take shape. I mean, if the market is soaring to new heights, but a lot of people aren't feeling it in their wallets, then what is that big number on the screen actually measuring?
Okay, check this out, because this is the heart of the issue. There's this massive, growing disconnect. The U.S. stock market has packed on trillions in value, and yet, for the average American, wages have basically been stuck in neutral for decades. So, how is that even possible?
To get our heads around that, we first need to break down what the stock market even is. And honestly, the best way to do that is to just forget all the complicated charts and the jargon for a second and think about something way simpler: a lemonade stand.
So let's meet Jill. Her lemonade is a huge local hit, and she's got big dreams of expanding. To get the money to do that, she decides to go public. She holds an initial public offering, or IPO, which is just a fancy way of saying she's selling off tiny little pieces of her business, called shares, to investors. And with all that cash, she can build her empire. Open newsstands, invent new flavors, and even give some of the profits back to her investors as dividends, which are kind of like a cash thank you for believing in her.
And that's basically it. That's the stock market in a nutshell. It's just a giant marketplace where millions of people every single second are buying and selling these tiny pieces of companies, all based on what they think those little pieces will be worth down the road.
Now, in the US, all this trading mostly happens on two big exchanges. You've got the old school New York Stock Exchange, the NYSE, that's the one you see on Wall Street with the big trading floor. And then you've got its younger, all-digital cousin, the NASDAQ, which is where you'll find all the big tech giants like Apple and Facebook. Okay, so with all this buying and selling, how do we get that one single number we see on the news? Well, that's where indexes come in. They take thousands of different stock prices and basically boil them all down into one clean, easy-to-follow number. The S&P 500, for example, tracks 500 of the biggest U.S. companies. The Dow, on the other hand, is like a super exclusive club. It only tracks 30 companies that it considers the most important. For a long, long time, the stock market was seen as this great engine for growth, helping companies build things and create jobs. But then, something changed. Something really fundamental about why corporations even exist in the first place.
You can see it right here on this timeline. Back in the mid-20th century, companies mostly operated under this stewardship model. The idea was they served everybody. Shareholders, sure, but also their employees, their suppliers, and their local communities. But then in 1970, the economist Milton Friedman dropped this bombshell idea that a company's only social responsibility is to make a profit for its shareholders, period. And that idea kicked off a whole new era of what we call shareholder primacy.
This quote just perfectly captures that old way of thinking. It wasn't only about the bottom line. It was about being a pillar of the community, about building something that benefited society. I mean, these are the companies that helped create the American middle class. And this shows you the new philosophy in a nutshell. The goal completely shifted. Suddenly, the only thing that mattered was bumping up that share price, and pretty much any way to get there was fair game. It led to this relentless focus on short-term profits, often at the expense of, everything else.
So what actually happens when making a company's stock price go up becomes the one and only goal? What are the real-world consequences when that becomes the entire focus?
This slide is, honestly, it's just stunning. It shows how companies started spending their profits. Between 2007 and 2016, companies in the S&P 500 spent a whopping 54% of their earnings on stock buybacks, which is basically a move to artificially inflate their own stock price. Another 39% went straight to shareholders as dividends. That left a tiny 7% for everything else. Things like, raising wages, investing in new technology, or research and development. And as companies started tying executive bonuses to how well the stock was doing, this happened. Back in 1973, the average CEO made about 22 times more than their average employee.
Fast forward to 2016, and that number had exploded to 271 times more. All the rewards were flowing right to the very top. But look, this isn't just about abstract numbers and charts. This is about real people. Let me tell you about the Wausau Paper Company. They were actually trying to invest in their future, trying to retool their factories for new products. But then a hedge fund bought up a huge chunk of their stock and started demanding they cut costs and boost dividends to juice the short-term stock price instead.
Well, under all that pressure, the company closed a paper mill in Brokaw, Wisconsin. 450 people lost their jobs. A decision that made the stock look good for a little while was absolutely devastating for an entire town.
And for the people who worked there, I mean, you can't even measure the cost. This quote from one of the laid-off workers just says it all. This is the human consequence when the stock market's priorities get completely disconnected from everything else. It's a pretty bleak picture, I know. It's easy to feel kind of helpless when you hear stories like that. But that story, as tough as it is, it's not the end of the conversation. Because at the end of the day, the stock market is made up of people. And that means people have the power to change what it values.
See, the market isn't some uncontrollable force of nature, like the weather. It's a tool. It's a tool that allows all of us, together, to decide which companies and which ideas we think are worth investing in. The real question is, are we using that tool to build the kind of future we actually want?
And here's the kicker, the part most of us don't even think about. Many of us are already shareholders. If you have a 401k or a retirement fund, you are a part owner of these companies. And unlike short-term speculators, we care about our long-term futures, right? We have values. And together, we actually have the power to influence how these companies behave. So the stock market isn't just measuring profits. It's measuring what its owners, the shareholders, are demanding. And that leaves us with one final, really crucial question. If we are the shareholders, what do we want the companies we own to value?